The used car market, which has been on the rise for some time, is now experiencing a significant downturn. Black Book's latest analysis reveals that subcompact car prices have fallen by 3.68% in the past week alone, as wholesale used car values decline. Federal repossessions are on the rise, and potential buyers are also holding off, resulting in one of the fastest downturns ever recorded. Lenders are even warning potential car buyers that their car loan may soon be underwater. With the average new car payment exceeding $700 per month, there is a concern that this may impact the entire industry, including the car in your driveway. So let's talk about the current state of the auto industry, the latest data, and the anticipated drop in car prices over the next few months, and how you can use this information to avoid losing money. Here's the breakdown. If you understand this, many of the pieces of the puzzle will fall into place. To begin with, you've probably noticed that car prices have been steadily increasing over the past few years. In fact, in 2020, 2021, and 2022, car prices outperformed the stock market, rising twice as much as home prices and 4 times as much as contemporary art prices. Moreover, 80% of new cars were sold above the MSRP, prompting questions about what's going on and when it will all come crashing down. To understand why vehicle prices have become the best performing assets in recent times, look no further than the 3 primary categories that are eventually coming to an end. The first category is limited production. Making a car requires all the necessary parts, and one of those is often overlooked: chips. In fact, a modern car now requires more than several thousand of these chips to function properly. Although it sounds like a lot, the auto industry only uses about 3% of the entire chip supply, while consumers use the rest. The used car market, which had been on a seemingly unstoppable rise, is now collapsing. A recent analysis by Black Book has shown that subcompact car prices have dropped 3.68% in just the past week, as wholesale used car values continue to plummet. With federal repossessions on the rise and a buyer strike, the downtrend is happening at an unprecedented pace. Lenders are even warning potential car buyers that their car loans could soon be underwater. Additionally, the average new car payment has surpassed $700 per month, causing concern that the damage will spread throughout the entire industry and impact the car you own. To understand the present situation of the auto business, the most recent data, and the predicted amount of car price drops over the next few months, we need to look at the 3 primary categories that have contributed to the rise in vehicle prices. The first reason is limited production, as a car requires numerous components, including semiconductors that operate everything from windows to navigation. However, even Toyota had to cut production by 50,000 vehicles in July due to a shortage of semiconductors. Low interest rates are another reason for the rising prices. Just like in the housing market, car buyers have been able to get record low interest rates for as long as 12 years, making cars more affordable than ever before. But as demand surpassed supply, the average car payment exceeded $700 per month, with 1 in 8 buyers paying over $1,000 each month. Finally, greed is also a significant factor, as automakers have realized that they can increase profits by reducing output. BMW and Mercedes-Benz are deliberately undersupplying demand to maintain pricing power, and Ford has even hinted at transitioning to a built-to-order business model. Overall, the collapse of the used car market is causing car prices to come crashing down, and it is essential to understand the reasons behind the rise in vehicle prices to avoid losing money. Car repossessions are on the rise due to high demand for cars, and this could have significant implications for the market. Typically, a rise in repossessions would be attributed to coming off record lows with loan forbearance, but in this case, it is due to the high demand for cars. Banks are warning that falling car prices could leave many borrowers in a difficult position where they owe more on the car than it is worth, making it harder for them to repay the loan. The average loan term for a car is 72 months, and people tend to sell their cars and roll over the remaining balance into a new loan before paying off the first car. As car prices start to plummet, KPMG predicts a 30% drop in used car prices, and Ally Financial forecasts a 2.0 decline over the next year. This rapid drop in car prices could cause buyers to become seriously underwater in a declining market, making it difficult for them to make payments on their loans. If this situation spreads throughout the entire market, it could have serious consequences for everyone involved. For instance, someone who took out a $40,000 loan to buy a car that is now worth only $25,000 may find it hard to make the $700 monthly payment, and could be forced to give up the car altogether. Let's take a closer look at CarMax, as its business model has typically been considered stable. They offer customers an instant offer for almost any car, which is valid for up to 7 days. If the offer is accepted, CarMax can then resell the vehicle for a profit. However, the company's stock has recently plummeted by 60%, indicating trouble for the entire industry. Additionally, customers are feeling the pinch of a triple whammy, as inflation is driving up automobile prices. As I mentioned earlier, prices for subcompact, midsize, and full-size cars fell by 1.72% to 3.68% in just 1 week, as rising interest rates make financing more challenging and consumer confidence declines. Furthermore, dealers are transferring inventory from auction to retail in an effort to increase prices, which has led to an oversupply and further price drops. Carvana, the used car retailer famous, or infamous, for its 24-hour car vending machines across the United States, is the epitome of 2020's exuberance. However, Carvana has lost an average of $3,255 on each vehicle sold, and its stock has fallen by more than 95% this year. In terms of current events, Wells Fargo has reportedly tightened its underwriting standards after noticing signs that borrowers are falling behind, resulting in a 40% reduction in auto loans originated by the bank. The bank even goes as far as to say that borrowers are now debating whether or not it's worth staying current on their payments, which could be challenging. Secondly, the price of automobiles is beginning to drop after doubling from its pre-recession highs. The situation in the automotive industry is beginning to resemble the rise and fall of tech stocks such as Shopify, Netflix, Zoom, and Pelican. CarMax, a company with a stable business model, has seen a 60% drop in its stock, which could indicate trouble for the sector as a whole. Inflation is also making cars less affordable, with prices falling by 1.72% to 3.68% from 1 week to the next for subcompact, mid-sized, and full-sized cars. Rising interest rates are making financing more difficult, while consumer confidence is also declining. Carvana, known for its 24-hour car vending machines, has seen its stock drop by more than 95% this year, and the company is losing an average of $3,255 on each vehicle sold. If lenders experience significant losses, this could be reflected in the stock prices of banks and automakers, leading to a decrease in the market as a whole. It is advised that those having trouble making payments sell their cars and get something more reasonable, or speak to their bank about repayment options. Most auto loans have a fixed interest rate, and driving the car longer than intended can help break even if the buyer owes more than the car is worth. Ally controls about 6% of the entire auto loan market, followed by Wells Fargo, Chase, and Capital One. It's unclear how much of the fall in stocks has already been priced in, and depending on the economy, unemployment, and interest rates, the situation could worsen. Please like and subscribe to the video and share it with friends and family.